Hey, welcome to this session of Coffee with Kirk. Glad you could join me. Just a couple of different things we're going to go through today. One of them is talking about I-bonds, get some questions on I-bonds. And then the other thing is kind of something I've talked about previously. Excuse me. And it's kind of like all the recession indicators have been flashing recession for a while. Why haven't we really seen it? And gotten some good information out there. And the big thing, a lot of these presentations for you is also just kind of going through my learning process and what I'm seeing and what I'm learning and trying to pass along to you guys. So it was an interesting interview from a woman that I follow quite a bit in the financial field. So we'll kind of go through that and go through some slides, what she's talking about. And it kind of sort of aligns with what I've been thinking a little bit, but we'll dig into that. First, though, I do want to go through, I get this question quite a bit, because obviously when inflation was ravaging the economy, I had done several presentations talking about I-bonds. And if you don't remember, I-bonds are essentially, they're government bonds. As a kid, you probably got, the Series E bonds or EE bonds that the government, your grandma would give you a little savings bond. Well, the I-bonds sort of replaced those. But the I-bond's a little bit different in that it's got an inflation component plus an interest component. So when inflation was going gangbusters, these things were, providing over a 9.6% yield. And it's basically a guaranteed return. I know, is the government defunct or not, but, they could always print money to pay the bonds. So it may not be worth all that much money when you get it, but they can always do that. So anyway, these things are, government issued, so they're about as safe as you can do in the bond market. And you were getting 9%. It was kind of a no-brainer. But since then, what we've had is inflation started to moderate. So we're no longer up at that 9% inflation rate. We're back down 3.5, 3.8, somewhere right in there. So it's like, well, does it make sense to keep your current I-bonds that you bought back when inflation was going nuts? Or, should I even think about buying more when I could go out and buy another government bond called a treasury bill? Treasury bills have a maturity of 1 year or less. And right now they're yielding, close to 5.5. So should I just sell my I-bonds and go into T-bills? Well, the thing is, I've been telling people no, and I want to kind of explain my logic. And again, this is a question I'm getting quite a bit from clients because they probably did buy them. And I've always kind of recommended I-bonds as sort of a cash replacement because you could usually get a little bit higher interest rate than what you get in your bank, and you don't have any additional risk because obviously the government backing is just as good as the FDIC, because if the government can't pay their own bills and bonds and notes, they're certainly not going to back up an FDIC account. So anyway, one reason I still like I-bonds is the current interest rate that takes place through April 30th, it's still at 5.27%. Now, the inflation rate has moderated, as I said. It's, back down to, I think right now in the I-bonds, it's 3.6%. So what's going on here? How are you getting 5.27? Well, it's finally starting to pay a fixed interest rate. So the government knows they have to be competitive in their interest rates in order to draw capital. So if they don't have a competitive rate for individuals, then they know that they're going to just run to T-bills and invest there. So they have actually added a 1.3% fixed rate. So you're getting that fixed interest payment plus the inflation component. Those two together, right now, it's a 5.27% rate. And again, this is annualized. So really over from November 1 to April 30th, you're only going to get half of that rate. But if it were annualized, you'd get 5.27%. They're actually another reason that I don't recommend selling right now, because the way that the I bonds work is you can defer your gains on these vehicles until you actually sell it. Now, if you want to, you can take the gain each year. You can take the interest payments and the inflation component reported on your taxes, but you've got to figure that out. You don't get any kind of tax document from the Treasury Department in order for you to know exactly what you should be reporting on your taxes. So nobody does this. Nobody actually reports it year to year. So in a way, it's almost like having an IRA. You are deferring your gain until you actually eventually sell it. And if you want, you can hold these I bonds for 30 years. They are technically 30-year bonds. They just keep rolling over every 6 months. So you could hold it for 30 years. And I've even seen people who had just a boatload of I bonds. And then when they passed, their heirs inherited these things at a step up in value. So they basically had, decades of what ended up being tax-free growth because their heirs took them and never had to pay any taxes on any of the interest or inflation component. So another reason if you sell them and move to T-bills, you're going to pay tax on what you had earned on the I bonds. And since the interest rate isn't that much lower than what T-bills are right now, you might as well stay where you're at. The other reason I do like, any government, T-bills, I bonds, is you don't pay state income tax when you do sell. So when you recognize the income, if you live in, it's a state that has an income tax, then you avoid taxation at the state level. It's only taxed at the federal. Now, I've got a lot of clients in Florida, Texas, Tennessee. If you live in one of those states that don't have a state income tax, that's really not a factor for you. But what is kind of interesting, because they have to remain competitive, this is the actual interest rate component. And what I've talked about before, you have to hold an I bond for a year. You cannot sell it within the first year. So you buy one, you've got to hold it. But after that, you can sell. However, if you sell within the first 5 years, you're going to give up 2 months of interest if you do that as a penalty. Now, I've been telling people, who cares? Like it didn't matter. There is no penalty, because for most of the past few years, the interest has been 0% or very close to that. Now, not so much. You can kind of see here, this is showing, going back to May of 2018, what the interest rate component was for the I bond. So you can see November of 23, it was announced at 1.3%. May, it was 0.9. But you can kind of go all the way back to November of 2019, and it was all 0%. And then it was 0.2%, 0.5, 0.3. So really the interest component was not much of the return. It was all the inflation component. And if we even go back, another decade, if I had a chart that could do that, you'd see that really 0% is what it's been. So you're actually getting some interest rate now, some interest part of it. And this is the inflation component. So this kind of shows you right now, the inflation component from the November to May is 1.97%. Now that's not annualized. That's actually over a 6-month period. So really, you're really looking at 3.96%. But you go back to that May of 22 period where it's 4.81, which that's for 6 months. So you double that. That's where we had that 9.62% return. And it was so enticing to get that. Now, if you are interested in I bonds, this rate goes until April 30th, this 5.27%. So if you bought an I bond, you can put in up to $10,000 into it. Even if you buy it on April 29th, for the next 6 months, you're going to get 5.27%. So, and then you will reset to whatever the May 1st rate is at the end of your 6-month period, which would be the end of October. So basically, if you buy at any period between November 1st and April 30th, you get that 5.27% for 6 months from your purchase date. Now, if you already owned I-bonds and we hit November 1st, you get 5.27%. And then on May 1st, you'll get the new rate. But if that 5.27 looks good, you've got some cash sitting around, maybe in a bank that's not getting 5.27, it still makes a lot of sense to think about I-bonds. So again, been getting a lot of questions on that because I was recommending it a lot before. So, okay. So the main topic for today is just looking at, is the recession really tabled, and why haven't we seen it so far? And, I was looking at pretty much all the traditional metrics that we've got. And the reason we saw inflation and kind of stock markets go and all that after COVID is we just had a massive amount of stimulus, both from the Federal Reserve through monetary stimulus, but we also had fiscal stimulus through the federal government in the form of extended unemployment, the PPP loans, those $1,000 payments that were going out, everything like that. They were just throwing cash at people. So what we've seen really since 22, when inflation started to hit, is we've seen the Fed do kind of what they do when they want to pull liquidity out of the market. They started raising the interest rates. So they went from a zero bound interest rate and pulled up to now at 5.5%. So they've been pulling just tons of liquidity out. And when you pull out liquidity like that, usually what you're going to see is some sort of serious economic slowdown. And you started to see it a little bit on bank lending. So bank lending is a huge part of our monetary supply. So this chart just basically, without getting too much into it, you can see from both commercial, industrial loans and domestic banks, lending is dropping. So again, when you're not having cash flow through the economy from lending, and you've got the Fed pulling money out, that's actually a deflationary effect. And I don't have a slide here, but you could also see that M2, which was the money supply, was also contracting. Now it's coming off of an enormous stimulus, so maybe pulling it out slowly isn't nearly as powerful as what the initial inputting of the stimulus was, but still it should start to have a slowdown. And then the other big thing is I've just been watching economic indicators, and these things are pretty solid. In any given time, you could have some indicators that show a recession and you don't go into recession, but what we've been seeing is pretty much all of the leading indicators are showing recession, and the numbers are still in recessionary areas. So we're still there technically as far as the leading indicators. So a lot of people who say, look, don't count out a recession yet, are still looking at how the leading indicators are showing. And, some of the big ones here, obviously the biggest one in my mind is the yield curve. And we've been talking about that for a long time. That's where short-term rates end up having a higher interest rate than long-term rates, which is not a natural thing to do. Typically, when you lend on a long period to somebody, whether it's a person, a government, corporation, if you're going to lend them money for 10 years, you want a higher interest rate than if you're going to lend it to them for 1 year because there's more risk. So the yield curve it's never been this inverted. And, that yield curve has been an absolutely really good bellwether. There's only been one period dating back to the Great Depression where we've had a yield curve go inverted and did not have a recession. That was in 1960, I believe it was. But other things too, housing and building permits. Housing is an enormous part of the economy, and we're starting to see housing slow down, housing build out a little bit, not rapidly, but we're seeing building permits start to slow quite a bit. So building permits leads housing, builds. So both of those have been going down. Manufacturing has been really for months now continuing to contract. And then consumer good orders. So when we say consumer good orders, we're talking more durable goods. We're talking washing machines and televisions and, things that are a little bit more expensive. They've been in recessionary territory. It's not unusual. There's things called leading indicators, coincident indicators of what's going on right now. And then there's lagging indicators. And I've been saying, everybody talks about unemployment to say why we're not in a recession, but unemployment is a lagging indicator. You don't really see that start to get impacted until we're well into a recession. It's usually the last domino to fall. And once unemployment starts to really go up, at that point, you're pretty much through the recession. So this chart just gives you kind of an idea. The red is the leading indicators, but the blue is the coincident. And what you can see from this is basically coincidence don't turn until the leading indicators have already, kind of fallen down. So and that makes sense because the leading indicators first go, and then the coincident indicators, and then finally the lagging indicators. So you can kind of see where we're at right now isn't unusual for coincident indicators. They haven't turned yet, but they usually don't, until the leading indicators have been going down for some time. Okay, so that's sort of a setup here for this quick video. Again, this is Lyn Alden. If you go into YouTube or anything like that, type in Lyn Alden, you'll get tons of information. She is really, really sharp and kind of looks at the economy and money a little bit differently than a lot of other economists. So I tend to follow a little bit, but she talks a little bit about why didn't we see a recession when all of the traditional leading indicators and actions by the Fed, they usually show a recession as soon as these things start to pop up, but it really hasn't yet. So she talks a little bit about that. So let me
changing gears a little bit. You've been speaking recently about something called fiscal dominance. And this is something I've also been kind of watching closely for a while. For those who aren't familiar with what this means, why does it matter? And how do you see it impacting what looks like a bull market in equities, what looks like a bull market in Bitcoin? How do you see that playing out? In other words, does anything stop this train?
Right. So fiscal dominance is one of the kind of rarer economic scenarios that developed markets find themselves in. And most investors in the past 40 plus years or so have not really traded those types of environments. Generally, it's kind of something for the history books, or those that are familiar with emerging markets are more familiar with the concept. Basically, if you go back to the two major sources of money creation in the fiat system, right? There's base money, there's broad money. How does broad money come into being? And the first method is that banks lend it. They lend money into existence. They kind of lever up the base money by creating more deposits by lending. And for example, the 1970s, which was characterized by rapid money supply growth and rapid price inflation, the bulk of the money creation came from bank lending. And that was because baby boomers, which were born starting in the early 40s, were entering their home buying years by the early 70s. and kind of continuing throughout the decade, you had a wave of home construction, of credit creation, of money supply growth, and then up against kind of supply constraints in the energy sphere. So that's an example of lending-driven inflation. On the other hand, you can run very large monetized fiscal deficits. So for example, the 1940s, when the United States is fighting World War II, they can spend a lot of money into the economy, issue a lot of bonds to do it, have their own central bank buy a lot of those bonds. And so you're spending money into the economy that you're not really pulling out of the economy. And therefore, regardless of whether banks are lending or not, you can inflate the money supply and inflate commodity prices, asset prices, wage prices, all sorts of things like that, and have another type of inflation. And when we look at the 1970s again, when the Fed's kind of managing inflation, almost all of its tools are about the first type, bank lending. They don't really do much about the fiscal side. And so, for example, in the 70s, public debt as a percentage of GDP was like 30%. and most of the money creation was from bank lending. And so if they raise rates and do other things that kind of convince banks to slow down bank lending, that should generally be disinflationary and recessionary. And, they might, for example, increase the public interest expense a little bit, but because it's low to begin with, it's a much smaller effect than the dampening effect they're doing on bank lending. Whereas when you fast forward to the current era, if you're over 120% debt to GDP in the public ledger, if you increase interest rates, you might slow down bank lending to a moderate degree, but you also completely blow out the fiscal deficits because of all that interest expense. And so the Fed's tools become less effective, and at extreme events can even become pro-inflationary. They kind of the tools either stop working, or in worst case scenario, they actually start working backwards, and they kind of are not really able to deal with it because the source of inflation is not from bank lending, it's from out of control fiscal deficits. And so what we see is in kind of the Western world in general, and especially the United States, structural deficits as far as the eye can see, and higher interest rates only make those deficits bigger. And so that tends to be a more structurally kind of pro-inflationary type of environment, either for commodities, wages, and things like that, or if there's enough disinflationary offsets, cheap energy and AI and things like that, then instead a lot of that money can get into asset prices, tech stocks, Bitcoin, assets like that.
Yeah. And so, I mean, and this is something that I think so many market watchers got wrong, right? They saw this Fed that was behaving, very aggressively. They were hiking rates. They were, fastest pace of rate hikes that we've seen in a long time. And a lot of people took that as like, okay, there's going to be this huge economic contraction. Markets are going to crash. We're hitting a recession. But I think like what they missed, and like what you're saying has gone on, is the fiscal authority, the government behind the scenes, has been issuing a ton of debt, spending a ton of money into the economy. And you've described this, it's a self-reinforcing cycle where actually the higher that the Fed raised these rates, the more it increased the deficit, the more it increased kind of the interest expense for the US. And then they have to issue more debt, and they have to spend, more money into the economy. And this is, I think in many ways, this is money that really gets into the economy in a stickier way too. So it's something that I think so many people got wrong. For those in the audience that are still kind of in that first camp, right? They're still really worried that we have these high rates and that's going to be really contracting the money supply. What would you say to those people as they're navigating their investment journey?
I would say it's important to be data dependent, and I was there with them for a period of time. So, for example, in early to mid 2022, I was expecting and writing about recession. And we were seeing that in a lot of the data. We were seeing a lot of rate of change indicators about the economy roll over. We saw falling purchasing managers indices in the manufacturing sector, contracting commercial real estate, just kind of decelerating economic indicators across the board. And so that was right for a period of time because the monetary tightening was bigger and faster than the fiscal for a period of time, about a year. But by the time we got kind of late in that year, and especially by the time we got into early 2023, it started to become more evident that the fiscal side was becoming large enough and overcoming, or at least balancing out, the monetary side. Partially because, as we just talked about, the monetary side ironically makes the fiscal side even looser. So the tighter you get on monetary, the looser you get on fiscal, assuming you have, say, well over 100% debt to GDP like we have now. And so once there were kind of early signs of that taking over, it became time to change and say, okay, we were heading towards recession. Now it's more mixed. That was kind of my stance for a while. And then after enough period of time of that, it's actually starting to become even a little bit more balanced towards the fiscal side. That doesn't mean that there's not challenges ahead. I think another way of looking at it is that right now we have an unusually sharp divergence between loose fiscal and tight monetary. So I think an easy framework to think of is that you're likely going to see larger than normal divergence between sectors, because some sectors are more dependent on interest rates and others are more dependent on fiscal. So for example, commercial real estate it's impacted by work from home trends, but then it's also, they have short duration debt that gets refinanced and causes a lot of problems. It's very interest rate sensitive. So that's certainly a sector that's in ongoing recession mode, having a really bad time. And there's other sectors like that as well. But then there's other ones, for example, travel and dining, right? That's, the people doing a lot of that are on the receiving side of a lot of this interest expense and a lot of Social Security and Medicare and all these things that are kind of pouring into the economy. They're going out and spending it into the economy. And so there are other kind of more service-oriented sectors that are doing fairly well. And thus far, those sectors are bigger than the ones that are in trouble. And so I wouldn't really think of it as the economy as a whole. Just think of it as sector by sector by sector, and then add up which sectors are more affected by fiscal versus which ones are affected by monetary.
Okay. So I thought that was pretty interesting. And it kind of, it makes a lot of sense to me. So as I'm learning, trying to get things out there to you all too. So as I looked at, well, why, I've been looking, why didn't we go into recession? And it's probably because we had so much stimulus from the government. So there's always monetary and then fiscal. So the fiscal is the government, monetary is the Fed. And an interesting point that she made is if the Fed keeps rates higher. So if we still see this sticky inflation like we've got right now, we're nowhere near the 2% rate that they want to be at. So if we stay higher and they keep rates up, that might actually make the fiscal side worse, because at that point, the government has to print more and more money just to cover the interest expense because we're so over indebted right now. The big reason this didn't keep going after World War II, and she alluded to, that's sort of the period we're in, sort of that during the war and then up until about 47, 48, we still had high inflation because the government debt was just so high. But fortunately, the government started to pull back on their spending. The public sector took over, started growing again. And so we got to the point where we went from over 110% debt to GDP in 1947 to down to 30% by the time we hit 1960. So the government was actually a little bit responsible, but also the public sector was growing a lot faster. So I've been talking quite a while now that I feel like we're in a longer term recessionary era. And I've been saying this for a while. And I'm showing some slides here. This is just the debt to GDP. I had to break it into two slides, but you can see during World War II, we hit 112.7% debt to GDP. So we had basically $1.12 of debt for every dollar of economic activity. But like I mentioned, you could see that went all the way down. So that by the time we got in the 60s, we were back to 30% debt to GDP. And then if you look at today, this is going back to 1970, you can kind of see we're up at 120% debt to GDP. So we're even higher than World War II, but we don't have a war that we're funding, at least not a world war like they had then. So, a big thing I've said, I feel like we're going to be in kind of a recessionary period an inflationary period over the longer term here, the next 10, maybe 15 years. We were in a deflationary period really since probably the late 80s until, probably until 08 really, or you could say we've been there until about 2020. I mean, you could make that case, but really from 1990 until 2020, we never really saw inflation much above 3 or 4% at its peak. So usually it was sub 3%. And you got to remember what is inflation. And I always talk about what Milton Friedman just said. It's basically when you just have too much money chasing the same amounts of goods and services. So what you have, what you have when that happens is just that, when too much money is chasing a fixed amount of goods and services, you're going to have inflation. That's what we saw when 2020 hit, when COVID was ravaging us. What we end up having is just the fiscal stimulus was just so massive, and so was the monetary stimulus that money was getting to us with all those PPP loans, with all the extra unemployment, with all the monthly or the $1,000 payments that they sent out, and then it went into the economy. So Lyn's saying that that's probably going to continue because as there's more and more of this debt, then what we're going to experience, sorry, I have a little problem with voice here. What we're going to just experience is probably more and more inflation. So that if we have these 120% debt to GDP, and it's only going to go up because of interest rates being up, as the debt costs go up, what we're going to find out is that inflation is going to continue to be here no matter what we want to think about. And no matter what we want to do, that's going to be a factor. And the problem is that the Fed has certain ways that they fight inflation, which is raising interest rates. And what she's saying is as they raise these interest rates more and more, or even keep them where they're at, it's just a circular loop, because it means that the government is going to have to issue more and more currency or debt in order to cover the cost. And like I've been talking about here, we have essentially 50% of our debt is going to be turned over here in the next 3 years. And if it does it at 5.5%, these current rates, the amount of our budget that's going to go to interest alone is going to be just massive. By the end of this year, we're going to be spending more on interest payments than we will on our Defense Department. And I think we spend way too much on our Defense Department. We shouldn't be at $800 billion for defense, but we're going to have more in interest expense than we're going to have in military expense. I mean, that's just nuts. And if, over the next 3 years, if rates don't come down, we could start to see interest payments alone start to get up there almost as high as our Social Security and Medicare payments. So it's just going to be crazy. So like I said, I've been saying we're looking at possibly inflationary periods here for the next few years, and I'll talk about that again, why I think that. I want to just show another really, really quick part of what Lyn's talking about. This is another video that she's got. And I'm just going to show a couple minutes of this.
With all the catalysts that we have upcoming, we're talking about the halving, the massive net inflows from ETFs and so forth, and maybe, the economy.
I certainly think that the diminishing return cycle that we've seen over Bitcoin's history is likely to break at some point. I don't have a high conviction if it's this cycle or next cycle, but I would expect it to probably eventually kind of surprise to the upside one of these times. And as far as kind of my overall retirement roadmap, the way that I think about this, the advantage of Bitcoin is that it is a long-term asset in the sense that, unless you're a professional trader, you probably really shouldn't be thinking about multi-week, multi-month price action. And instead, it's what does it do over a course of one or more kind of full cycles in the asset, which is the kind of thing you think about in longer-term retirement portfolios. And so over the past 40 years or so, until kind of this recent few years, the developed world's been in this structural disinflationary trend. And the types of portfolios that do well in that environment are basically all of the assets that benefit from disinflation. So large cap equities, bonds. And when you combine those together, during economic expansion, stocks do well. When economic contracts, the bonds take the edge off. The problem is that when you kind of enter a more fiscal dominant type of situation, or a situation where inflation is on average running hotter, right? So the 1970s are an example, the 1940s are an example, and a less extreme example would be the 2000s decade. But when you run into kind of a longer period like that, stocks and bonds become less attractive at hedging each other. Generally, bonds are less likely to go up when stocks go down, or bond yields going up, meaning bond prices going down, could even be the reason that equities sell off sometimes, because now that's kind of changing the discount rate that you value equities at. And so in those types of environments, historically, things like commodities and energies were kind of the one area that an investor could turn to add to their portfolio. And instead of having a two-part portfolio, they could have that three-part portfolio, which can really kind of hold up better and hedge them better. But of course, now we have tools like Bitcoin as well. And I kind of put it into that third camp, which is assets that can do quite well in a more inflationary period, in a more fiscal dominant type of period. But they can, of course, also do quite well if just overall asset prices continue higher as well. So the way that I think about constructing a long-term portfolio in this type of, very uncertain environment, and especially one where I'm kind of trying to keep volatility to, somewhat in a reasonable range, I'm thinking, okay, here's an equity basket. I'm thinking, okay, here's like a defensive kind of hedge against kind of disinflationary moments, things like cash or, certain durations of bonds, for example. And then I think, okay, what is the protection against currency debasement? What is the protection against these other things? And that'll be things like energy stocks or things like Bitcoin that I think really kind of round out that portfolio and actually help, even though some of those assets on their own can be highly volatile, they can actually reduce the risk of a portfolio. Basically, by that, I would mean not, sometimes it can reduce the volatility, but it can also just kind of reduce the chance that your purchasing power is insufficient by the time you reach retirement.
Okay. So that was just a second little follow-up there. Because, first they had little short videos and this was an interview of some guys that do Bitcoin and they're asking her about that. But what her point was, and let me show some slides, is what we've had traditionally is just, you go back to really the 70s, it was, you looked at two asset classes. You're either in stocks or bonds. And, you did traditional, okay, I've got a 60-40 portfolio, 60% stocks, 40% bonds. And like she said, is when stocks were doing well, bonds provided some interest, but you really didn't have the bonds in your portfolio for that. What you had the bonds in your portfolio was when stocks struggled. When we had, kind of a recessionary period, stocks would tank and the bonds would buoy your portfolio. Well, she's saying that if we're no longer in kind of the traditional era where the Fed has control because of the monetary levers that they can pull, if we no longer have that situation where now we're in a point where it's the fiscal, it's the government spending that's going to be kind of the overriding force, then this kind of portfolio is just not going to do well. And you saw that in 2022 when both stocks and bonds took it on the chin. So you have to say, did stocks go down that year because bonds went, the interest rates were going up and bonds went down and that caused the stocks to go down? Or was it something different than that? Was it the money coming out caused the stocks to go down? Who knows? But what you're probably going to see is you don't necessarily have that cushion with bonds that you normally had before when stocks would struggle. So you can kind of look here. This is the bond market. This is the 10-year treasury. And, for all the way back to essentially the 1970s, late 70s, until 2020, we had a enormous bull market in bonds. Rates were going down. And remember, when rates go down, the price of bonds go up. So that's when rates go down, that's good for bonds. So we've had a 4-decade long bull market. And now you can see at the tail end on the far right, is it starting to shift? Now, could that come back down to zero? It certainly could. But if we have a situation where the fiscal side of the house, the government, is creating this inflation, the Fed is going to keep rates up, because if we're already getting inflation from the fiscal side, then the monetary side, or the Fed, would be foolish to come back down to 0%, at least from an inflationary standpoint. Now, the Fed might have to come down to zero at some point and just buy all our bonds when it starts to become untenable, when interest rates start to really go up. But that's sort of a different story. We're just kind of talking here. If we're looking at inflation alone, the Fed is not going to be in a position where they can start to pull rates down. So what Lyn was saying is, okay, you're still going to have stocks and bonds. You're probably going to look more on the bond side, is going to be probably shorter term bonds like we've got right now, T-bills. You'll still have some stocks, but you're going to have some sort of alternatives or other asset classes that really have a different correlation to both stocks and bonds traditionally, and those that do well during inflation. And as she had mentioned before, you want to look at sectors. Sectors are going to be an important part. So she said you want to kind of avoid interest rate sensitive sectors. So that's going to be like your real estate investment trust, commercial real estate, because it's obviously real estate is so heavily dependent on mortgages. That's going to be probably a lower return over time than what you're going to get from other areas. Other areas that could struggle a little bit are things that are capital intensive, manufacturing, industrials, mining, where you have to spend a lot of money to build your factories or your infrastructure in order to do your business. Sectors that do benefit, she had mentioned, obviously travel, dining out, services like that. They're obviously going to do well if of the people receiving, she said, Social Security, if you're getting government payouts and that money is coming to you, you can still put that on into the economy. But some other areas that'll do well in this defense industry is obviously going to do well, especially since we seem to always want to be in a war or some sort of military conflict. But it's also going to do well just in situation where the government's spending tons and tons of money. Of course, the other things are the general commodities, energy and agriculture. I think being a contrarian is going to be important here going forward. I've shown this slide. When you look at the U.S. compared to international stocks, both developed international and emerging markets, there's just compelling values that can be had in international relative to U.S. stocks. I'm going to skip this one for right now, but the big one that she sort of mentioned was commodities. And I'm going to talk about commodities here. I've always kind of talked about the benefits of commodities at certain points. Commodities are a funny thing. It's one of these, it's either going to be an enormous boom to your portfolio or it's just going to be a huge drag. Now, I've always had a little bit of commodities allocated portfolios. And, for years, people would say, well, why are we wasting our time with this asset class? Just throw it in the stocks or throw it into bonds, because it really went nowhere for years. But you can kind of see that's sort of how it is. This is the Goldman Sachs Commodity Index total returns, and basically broken down by decades. And you can kind of see that commodities is something that is very secular in nature. They have longer periods where they go up substantially, but they also have long periods where they go down substantially. There's no like normal 6, 7, 8% per year from commodities. It's either you're in a commodity bull market or you're in a commodity bear market. And there's not a whole lot different. And I've shown you graphs here in the past few sessions just showing how commodities relative to stocks are at an all-time low. So you have to think that maybe we're in a position where we're entering one of these decades where commodities are going to be a much better place to be. But even if you don't want to say, well, is this next decade going to be a great year for commodities or not? There's just a great benefit to having commodities in a portfolio compared to stocks and bonds, just from a diversification standpoint. She said you could invest in assets that on their own are very volatile, but yet when you add them to a portfolio with other asset classes, they actually reduce the volatility. And that's what happens with commodities. this chart kind of shows you how the interaction between commodities, equities, and bonds are. So when you look at this, what you want to try to look at is the number one. So if you look at the top left, you got the Bloomberg Commodity Index. You come over, and the first column is the Bloomberg Commodity Index, and it's at a 1. Well, that's because it's the same. So a 1 is a perfect correlation. That means they're going to move together perfectly. So when you look at the column for the Bloomberg Commodity Index, and then you go down to U.S. equities, you see that there's only a 30% correlation. So that means only 30% of the time when U.S. equities are going up, commodities are also going up. So there's a very low correlation between commodities and equities. And also, if you then go down to global bonds, you see there's only a 30% correlation between bonds and commodities. So you're getting an asset class that has a low correlation to both stocks and bonds. So when you look at U.S. equities and global bonds, there's only an 18% correlation. So as you start to put those three together, you can build a portfolio that essentially has less risk, even though the underlying components might be risky unto themselves. This is a chart. This is a very busy chart. If you've been with me for a long time as a client, you probably heard me mention the name Roger Gibson. Roger was a financial planner up in Pittsburgh area. And he wrote a great book. I think the first edition was in 2005. So I've been following him for a long time. But what he did is he just tried to show the benefits of diversification. He basically took 4 assets. He took the S&P 500. He took the MSCI EFA index, which is international stocks, he labeled a B. The S&P 500's A. He took real estate investment trusts, which was C, the Nareit Equity REIT, and then the S&P GSCI, that's the S&P Goldman Sachs Commodity Index. That's he labeled that one D. So he had A, B, C, D. So on their own, you can kind of look at this chart. Along the bottom, we have return. So the further out to the right we go on the bottom axis, the higher the return. But on the y-axis or the vertical axis, you have standard deviation. So the higher you go up the chart, the more volatile the asset class. So you can actually see that in this chart, the worst performing and the most volatile asset class from 1972 to 2012 was commodities. It was the worst asset class to be in. If you were going to be in only one asset class alone, that was the worst one to be in. Now, incidentally, over this 40-year period from 72 to 2012, real estate was actually the best one from both a risk and return standpoint. I couldn't find a chart that looked like this that went all the way through today, but this still gives you a pretty good idea of what we're talking about here. And I apologize for the noise in the back. We've got our tax office going, and it's a little loud. So anyway, now the interesting thing is you've got the most and lowest performing asset class of commodities, but as you start to build diversified portfolios, as you start to add D to other asset classes, and then you start to build them out, from a 2-asset class to a 3-asset class. And then we get to the point where you have all 4 asset classes in a portfolio and they're all equally weighted at 25%. That's portfolio A, B, C, D on there. Well, what you find from that is if you look at the portfolio A, B, C, and then you go to A, B, C, D, you actually, from A, B, C, so that's going to be your U.S. international stocks and real estate, and then you add commodities. So from ABC to ABCD, you actually increase your return and reduce your risk, even though commodities was the most volatile asset class and the lowest performing. And the reason is the correlation to stocks and bonds and real estate were such that when you had those periods, when you had these decades in there, like 1982 to 89, when bonds were struggling initially, real estate was struggling initially, Stocks did well, but so did commodities. Commodities did fabulously during that period. And then if you look at other periods, maybe 94 to 96, things like that, when you had those years and commodities did so well, it actually helped buoy your performance over the longer term. Now, from year to year, that's not necessarily going to be the case, but over the longer term, it is. Now, the reason commodities are so volatile is there's a lot more factors weighing in on commodities than there are in other asset classes. The first one, it's just they're not quite as liquid as your typical stocks and bonds. You've got to access it through futures markets. So it's just not, you just can't get the liquid markets that you're going to get with stocks and bonds. You're very dependent on Mother Nature. So if you have a drought, if you have too much rain, if you have cold temperatures, if you don't get enough sunlight, that can have an impact on a lot of commodity prices. It's also supply and demand. So sometimes when you have a booming economy, the demand for commodities is obviously going to be much higher as people produce more goods and services. But the opposite's true as well. The other thing is commodities are more affected by geopolitical happenings than, say, other asset classes. So I just saw a question in the chat about, what do you think about the Red Sea? What's going on there? How's that going to impact things? Well, that's one of those cases. What if we started to shut down shipping lanes in the Middle East? What's going to happen to the price of oil? I mean, I think it's pretty obvious what would happen. And then finally, the other thing, commodities can be pretty volatile. As I mentioned, they're traded in the futures market. And when you're dealing with futures or options, you can add a lot of leverage to your positions. And a lot of dumb investors do that, and they end up creating a much more volatile environment when they do that. So that's sort of the reason why commodities can be more volatile, but yet you can still see that adding them is a great thing. Now, I just want to go through some slides I've shown you in the past of why I think we're in a longer term inflationary environment. Now, I do think there's going to be periods where we'll see deflation. And if we do go into a recession, which is still a probability, I think, when I look at a lot of these leading indicators, they're still showing recession. And the consumer is strapped. I mean, people are strapped. And if they pull back, that could lead to a recession. But anyway, the reason I think we're going to have more of an inflationary environment over the next few years, part of it comes down to we're breaking away from what's been going on the past 20, 25 years. And there's two relationships mostly that are breaking up here. The first one is us and China. So as we started to enter the 1990s, and you could even argue in the late 80s, we started to outsource a lot of manufacturing to China. We were trying to bring them into the world economy. So basically what happened here was as more and more manufacturing went to China, as American consumers, we actually had cheaper goods, which was disinflationary. So even though we were buying more stuff, we weren't paying more for it because of the cheap Chinese labor. And then what did China get? Well, China got a trade surplus. They used that trade surplus to basically build their military, build their internal infrastructure. They also got a lot of technology from us, mostly from theft, but also some of it we gave to them willingly. So this relationship's been going on for decades now, but we're at a point where the United States has started to realize we can't have everything manufactured in China. I mean, we would be so screwed right now. I mean, China builds our transformers for our electrical grid. They do all our medicines. They do all our, they build our cranes that we use for construction. Everything is built there. So right now, if they shut off the spigots, we would be done. It's over. Game over. We do not have the manufacturing capacity. So we are starting to build manufacturing capacity here in the United States. We started to do that when Trump was president, and it's continuing on with Biden. So we're starting to onsource, but that's going to be inflationary because we're not going to be paying, kids 20 cents an hour to make Nike tennis shoes, they're going to actually have to pay more of a living wage to those in the manufacturing industry. So that's going to be a long-term inflationary trend. I mean, I think ultimately it's good for America, both from a security standpoint, but also from a job standpoint for people. They're going to have an opportunity to basically have some higher paying manufacturing jobs. Having grown up in Flint, Michigan, I've witnessed the gutting of the manufacturing industry and what it can do to the local economy. But there's also one other dynamic that's changed, and that's basically the European Union and Russia. And much like us with China, both sides got something. Rather than cheap goods, what the EU got was cheap energy. So they were able to keep their costs in check because their energy costs were going down due to cheap Russian gas and oil. And of course, Russia had a trade surplus due to that, which helped them build their infrastructure and also helped them build up an enormous gold deposit that they have now. And they also got some technology. But as we can clearly see, that this is breaking down due to the Ukraine situation. So, I think over the next few years, what we're looking at here is some inflationary headwinds. One of them is going to be, rearming, as Russia and China build their arms, we're probably going to do the same. And we're already spending $800 billion on the military. So that's going to all be inflationary. We're going to reshore or onshore a lot of our manufacturing, so we don't have to worry about shipping products 7,000 miles and face a potential blockade from China. So I would expect, even if it's not here in the United States, a lot of this manufacturing is going to be in Mexico, Central and South America. We're just going to try to create a much shorter, manufacturing line than we had before. But the other thing we've talked about a lot is how we have underinvested in commodities. The government's been really hammering on coal, natural gas, oil. And while we certainly have tried to beef up the solar and wind component, solar and wind are so far away from being able to take the load from coal and natural gas and oil. It's for you to think that we can replace it is foolish. So the fact that we've been underinvesting in those is going to be inflationary because energy costs are going to be higher. So either we're going to have to reduce the amount of energy we use, which would be catastrophic for the economy, or we're going to end up paying more for our commodities. And we've also talked about it. I think the answer is nuclear, but you can't just flip a switch and have nuclear energy. But it's clearly something that we can have a cleaner energy, but also more abundant and energy dense. And then finally, we have a horrible grid right now. We absolutely have a horrible grid that's going to have to be completely replaced and reinvested in. So, we've got some issues on that. And I know I'm bumping up against that hour here, so I try to keep it to an hour. So I'm just going to finish real quick with, so commodities are definitely going to be something that's going to be part of the portfolio. I've been talking about energy for a long time, but I think we'll see more of that. Even gold's probably going to be play. But there's other assets that I'm looking at. I haven't pulled the trigger on these buffer ETFs that I talked about for a while. But these are some different tools that essentially use options on the stock market. And by doing that, you can create a more mathematical outcome. So this looks at a fund that we've talked about in the past that gives you a 25% buffer. So the way it works is the fund managers will buy put options, which when you buy a put, that means you expect the market to go down. But they'll also sell call options. And call options, you think they're going to go up. So what these two options, I'm not going to get into it because we're running late here, but basically what this does is it creates a more consistent return. So by selling the call options, they've limited the upside that we're going to realize on the stock market. So we buy the S&P 500, sell a call option at 15% above the current price. So no matter what happens, you're only going to get to the upside 15%. So if the market goes up 8%, you're going to go up 8%. But if the market goes up 30%, you're only going to go 15%. So the reason you do that is because you take this call option you sold and you buy a put option. And this put option, the way it works on this particular buffer ETF is they buy a put that's 5% below the current price, but will protect you for the next 25% from thereafter. So if the market goes down 5%, you're going to be down 5%. But if the market then continues to go down, and let's say the market goes down 30% overall, you'd only be down 5%. If the market goes down 20%, you're down 5%. If the market goes down 50%, you're going to be down that initial 5%, and then from down 30 to down 50. So you'd actually be down 25, but down 25 is a lot better than being down 50. So I think these things could be a good replacement for both stocks and bonds. So bonds are in a situation where they're kind of in a inflationary environment. They're not going to do well overall. So maybe you use something like this that could get you a higher return to the upside, but also protect you if the stock markets start to head south. So those are some of the asset classes. I'm not going to get too much more into that again, but just looking at some different kinds of asset classes that we can utilize for that, that third of the portfolio that Lyn was talking about, that basically takes you away from just the normal traditional stocks and bonds and gives you a way to better navigate an inflationary environment. Okay, so again, I'm sorry we're a little bit long here. Some questions and comments. Okay, inflation's no longer going crazy. Inflation's still bad. And the problem with inflation is it's a compounding effect. So when we had inflation at 9-10%, it's not like that went away. As inflation subsides, it doesn't mean what we've already experienced isn't still priced into all the products that you're using. It's just that, okay, well, if we're not going up 2%, we're going up 3.8 right now. That's still high, and it's high on top of what we've already gone through. Okay, what are your thoughts on the Reddit IPO? I don't have any thoughts, honestly. I don't know. I know nothing about the back end of Reddit. It's just a message board. I don't know. I don't think it's as sticky as. I don't know if there's a moat there that would make it financially viable over the long term. Maybe there is. I don't know. Okay. Thoughts on Red Sea and the choke point? Yeah. That as this progresses and gets bigger, I mean, it's pretty clear that Israel's not pulling back anytime soon. So there's going to be conflict in the Middle East. And at some point, somebody's going to do something to escalate it even beyond where it is now. If that happens, we're going to see probably the price of oil climb quite a bit. And we're already starting to see OPEC is reducing production. So you're probably starting to see gas prices go back up. They're pulling back a little bit. Part of it, they say, well, we want to maintain a certain price level, but it's also probably a little bit of a punishment for support of Israel. Thoughts about the settlement by the real estate agents potentially lowering their commission? Yes, Steve, you sent me an email on that. I'll probably do that for the next one. So that's going to have a big impact if you're a realtor. It's the real estate industry, I've never figured that out. It's the only market where you're buying something that's that expensive and there's absolutely no transparency whatsoever. I mean, if you talk to an agent, let's say you're looking at a house and that agent, there's another agent on that represents the sellers. Well, they can say whatever they want to. Oh, I've had a lot of interest, or, oh, the offers are flying in. You don't know how many offers are coming in. They can completely lie to you to basically change your behavior. So I've never understood why we don't have something where it's all completely transparent. If there's an offer, you see what offers are out there. You can make a more informed decision. It makes the market much better. It also kind of legitimizes the real estate industry. So, they're not all kind of just shysters that are lying to you. But the other thing it's going to do is lower the cost of commissions because there's just not as much of a need for it. But this lawsuit, we'll talk about that. The settlement is basically going to have a major impact on the cost of buying and selling real estate. Oh, great point. We'll finish off, Rob. Chinese built our container cranes too, with comms upgrades. Yeah. So a lot of our container cranes, our construction cranes, all that they have within them, basically China still has control with some of the microchips that are in there. They say they're doing it so that they can fix it quickly. If something goes wrong, we can transmit that information to the original manufacturer, and they can help repair and rebuild our cranes and your infrastructure a lot faster. But it also gives the ability to shut it off too if they wanted to. So they could shut off all of our construction gear on top of that. So yeah, that's a great point, Rob. Anyway, so I've taken up a lot of your time. I try to keep these to an hour, a little bit long, but this was just a really good video talking about. She did a great job encapsulating some thoughts I've been working around. We're probably are in a different investing environment here for the next 10, 15 years. We're going to see more inflation. So how do you navigate that? Something we haven't seen in quite some time. And it's one of those, it's now more fiscal is driving the train rather than monetary. And there'll be ebbs and flows with it, but it was a really interesting concept that she had. So anyway, again, if you have questions, please send them to me. The whole thing about I-bonds was from client questions. So please shoot me questions and I'll try to get this information out to you. So have a great weekend, everybody.